Hey guys, welcome into another YouTube video. Today we're going to be talking about index funds. So this video was by viewer request. Someone's asked me to talk about index funds, so here we are. So firstly I'm just going to read out this definition here. So index funds are investments made up of stocks that mirror the companies and performance of a market index, such as the S&P 500. Index funds are passively managed and have lower fees than actively managed funds, and often generate higher investment returns. Index funds are well-diversified investments. So essentially that means you have an index fund like the S&P 500 here, and it's got like a whole list of companies that are within the S&P 500, and they just automatically invest into each of those stocks based on the weighting of that stock in the index. So if one company has a 1 billion market cap and another one has a 10 billion market cap, you hold 10% of the smaller one than you own of the larger one. So it's like all scaled down, because if they were to try and split it evenly across all the companies, then you would own more than the value of the company. You can't do that. You'd own way too much of the small companies. You'd own 100% of them. So you can't do it. It has to be evenly weighted as per the index valuation of each company. Yeah, so mostly going to focus on S&P 500 in this video. So we're going to talk about kind of whether I think index fund investing is a good idea, which I do. I think it's a great idea, depending on the person. So there's kind of like different tiers of investing that you kind of want to get into, like depending on your knowledge and experience. So if you're just starting out, it's probably not in your best interest to do like what I did and just straight into stock picking, because for me it worked out. I randomly happened to get in literally like here. That's when I joined the market. So yeah, I happened to get into the market at a really good time. That's not going to happen for everyone. So it like over time it does make sense on from a safety perspective to invest in index funds, especially when you aren't too confident with stock picking. But it also does depend on what kind of returns you're after. So the average Smp returns, according to this website, around 10%. According to this one, 10.7%, 10%. I mean, this one says 6.61%, but it really depends where you start measuring from. So there was some huge crashes back in the day, like I think like 1920 or so. There was massive crash, and if you start measuring after that one, you're looking at about 10% per year, which 10% per year is like a great return for something that's fairly risk-free. When I say fairly risk-free, obviously refer back to the chart. If you invested here and the market went down 38%, like yeah, or same thing here, market went down 50%, again here, real fast crash. But there's definitely risk in index funds and in just anywhere in the stock market. So yeah, don't invest unless you're willing to assume that risk, but there's a lot less risk in investing in the like indexes. Also, if you're investing in indexes, I would highly recommend that you don't try and trade at all. Just like if you're investing in like the S&P, it's probably because you're wanting stability and a good risk reward kind of trade-off. So it's low risk, but then 10% is a fairly low reward. Considering the amount of risk, like, it's pretty damn good, to be honest, because if you're looking at savings accounts at the moment, like in New Zealand, we're getting like 0.1% if you're lucky, like pretty much inconsequential amounts in savings. Yeah, if you're looking at other investments, like, there's not a lot else you can go for. Stocks, crypto, and property, and I mean, there's a lot going around about property market in New Zealand, whether it's overinflated and whatever, but we're not going into that in this video. We're just saying this is, well, an index fund investing is a lower risk form of investing. So yeah, 10% returns, which if we jump over to an investing calculator, so this kind of shows you the power of investing and kind of why you should invest. This doesn't necessarily mean you should only invest in index funds. This just kind of shows you should invest in general. So the key thing here being that you're investing over a large number of years and you are getting like a consistent return. If you can't get that consistent return, then, like, if you're taking too much risk, say you're gambling, you're going to lose all your money, or you're speculating, or you're not educated on what you're investing in. Yeah, you're going to lose all your money. So this return rate has to be like fairly stable. So if you're investing in stocks, you need to be fairly good at picking stocks. If you're not, then go for index funds. Yeah, so I've just chucked in a few numbers here. Starting amount of 10,000, a 30-year investment, 10% interest that we get in the S&P 500, and just $200 per month. As you can see, it's a total contribution of 72,000, but in the end you end up with 657,000, which is absolutely insane. This is I commonly refer to it as the infinite money glitch, even though it's not really accurate, but it's just like how the rich people get richer and people without money just never amass money because they don't invest. Yeah, so 10% for the S&P is great. Like, if you extend your time horizon out to 40 years, calculate that out, like, suddenly you've got a ridiculous amount of money. So if you're like 25 or under, like, you have 40 years. So you can actually, like, this is feasible. I mean, even with no contributions, you're still going to end up with, like, turning 10,000 into 545,000, including the initial investment. So that's pretty insane, really. But then, yeah, where it really gets powerful is like, how much can you invest per month? Can you invest $500 a month, end up with 3.7 mil? I mean, personally, if I was only focusing on stocks, I could probably invest 1,000 per month fairly easily. So it could end up with, in 40 years, when I'm 64, like about to retire, I would have 6.9 million. Could probably, what could I get? 1,500. I could probably do 1,500. I could end up with 10 mil by the time I retire, just from stocks. And I mean, I have a bigger starting amount than that. I've got about 59,000 in the market currently. Notice how that changing that up like almost 6 times more didn't really make that much of a difference here. The big difference is the contributions, the percentage, and the number of years. So the reason that I don't invest in index funds is because I have more ambition than this number here. But if you value safety over like ridiculous numbers, I don't know, whatever your life goal is or whatever, could be a lot different to mine. I don't specifically have a number that I want to achieve. I just want to achieve the most I can, like fulfill my greatest potential. So that's why I don't invest in index funds, because you're kind of limited. If we actually take a look back here, there was one link that mentioned the past performance. Yeah, so the Smp 500 1-year return is at 29% and 19.6% last year. So you can actually get pretty huge returns on the Smp 500, but this kind of lines us up for some not so great years to go in the future. But with an average of 10%, like, I'm wanting to earn more than that. I have this number that I really like, which is 26%, which is the number that I'm aiming to get. I don't plan to invest that much extra. I might invest like an extra 500 a month. That's my current value, and I do intend to invest for probably 40 years. Don't know if I'll do any withdrawals or anything in that time. It's a long time to be predicting over, but if we calculate that out, $2.6 billion. So that's massive. It's like, man, you have to count the figures. Yeah, so really unrealistic that would ever happen, because 26% is better than Warren Buffett. But it's kind of, it's one of those things where if you aim above, you aim high, and then if you get halfway there, you've done really good anyway. So I mean, so long as I'm beating the Smp 500 as a stock picker, I'm still gonna continue to stock pick, even though I admit that I'm not the best at it. And yeah, I could probably stand to learn a lot more, but I'm getting better with time, and hopefully that'll show in the returns. Yeah, just got quite lucky when I started investing. If I managed to hit that return rate, I would be incredibly happy, and that is a lot of money compared to the 10% that you can get from index funds. I mean, yeah, 6 mil is still a lot of money. I could have 6 mil by the time I retire, but I mean, thinking about, like, a property in New Zealand costs like $1 million these days. So what's it going to be in 40 years time? Like, I've heard figures thrown around about real estate, about property doubling roughly once every 10 years, which seems a bit high to me. But just say, for instance, that it did, and it doubled 4 times, 1 million to 2 million to 4 million to 8 million to 16 million. It's probably not going to happen, but that's a lot of money. Like, yeah, I don't know, pretty crazy. But if I had that 26% rate of return, hey, that wouldn't matter so much, would it? But yeah, so the kind of people that I would recommend investing in the Smp 500 to, there's a lot of different people who this could work for. So anyone who doesn't have confidence in their stock picking, anyone who does have confidence in their stock picking but isn't doing very well, or anyone who's been potentially speculating on things that they shouldn't, or gambling or anything, taking too much risk. You're probably going to want to take a safer approach, and because if people who have gambling addictions or aren't good at managing risk reward, they might be tempted to get carried away when choosing stocks. Whereas if they chuck it into an index fund like this, then you can actually, settle it down, kind of detach from it and just let it grow. Who else? People who are planning on retiring in like the next 10 years or so. If you're like 1 or 2 years away from retiring, probably not the best idea, because there's the chance that we go through a 10, 20, 30, 40% correction or crash, and if you're going to need that money soon, it's a bit bad. Personally, I would suggest for young people as well. Even like you're looking at buying a house, you've got five years away from buying a house, and you've got a bit of a deposit down. You've got 59,000. You can make in that 5 years, like you can turn your 59,000 into 136 just by investing in the S&P 500 and putting in $500 a month. Putting in $500 a month for 5 years would also show the bank that you're good to give a loan to, so they'd be much more willing to work with you on giving you a loan, and you'd have a much bigger deposit. Obviously in 5 years the property market's also going to change as well, so a bit of a risk, but if you're leaving it in cash, I would say that's the bigger risk, is not getting any gains while inflation comes and makes everything more expensive. I probably missed like a whole bunch of people. It's good for young people, anyone who's kind of got 40 years, if you got 40 years or even 30 years, you can make some horrendous amounts of money just by investing in the S&P 500, getting a 10% rate of return. So I would generally recommend index fund investing to anyone, unless they're already into stock picking. You generally don't want to tell someone who's doing their own stock picking to kind of take a step back and start investing in index funds, because it kind of feels like a step back. It's not necessarily a step back. It's it's still investing. You're just choosing a different risk reward balance. And I reckon index fund investing would suit a lot more people than stock picking, which is kind of reflected in the numbers by how many people invest in index funds and money management, or ETFs and like managed funds and stuff. Like most people choose to invest that way as opposed to stock picking. Actually, I'll speak about like the managed funds. I don't specifically like managed funds, with kind of one exception. I do like ARK funds. So technically it's a managed ETF, but I really like ARK because they actually invest in like high growth, and they're not reactive to the market. So one of the things that I don't like about the managed funds is like they're always kind of counterintuitive. They're doing the wrong thing at the wrong time in order to say that they've done something to people who don't know anything about the market. So you hear one day that Tesla's going bankrupt or something, and you see it on the news, and you just think, oh shoot, I've got some money in this managed fund. I need to go see what my managed fund's doing. And then you see like, oh, they sold Tesla. Okay, I'm happy. But then they sold it after it went down, because when it went down, they're like, oh shoot, everyone's gonna want us to sell it because it looks like it's a dangerous stock, because there's still articles coming out about it. So it seems like retrospective. Obviously I'm categorizing them and like grouping them all up, but obviously they're not all going to be like that. But I feel like I've seen a lot of that, and I just personally find it hard to get behind someone else's decision. Like, it just feels like I should make my own decisions. So I mean, index funds, you're not getting behind anyone else's decisions. Like, you're not investing in someone else or trusting anyone else or anything. You're solely trusting the market, really, which is something that you can do research on. You can look at the market, and you can say at any point in time, how long can it go down for before I actually start making money. So how many years can I lose money for? Like, how many years till this goes positive? So like, worst case scenario here, it's like 7 years before you go positive again and have another crash. So what's that worst case scenario? From 2000 to 2012, 2013, 13 years to break even. Okay, that's pretty bad. I'll give you that. But that's like a very rare situation. Don't lump sum invest, I would say. That's probably another point to mention. So this here, continuously contributing $500. It's a form of dollar cost averaging. So you'll be investing, you know, dots across the market, like invest here, 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 and then all the way across. So you're not just putting like one lump sum in that's gonna only break even in 13 years, because that is a risk in the market, especially if you look at the shape of this graph. It's pretty crazy. But also, if you're looking at the shape of this graph and you're thinking like, damn, it looks like the S&P 500's looking for a crash, just keep in mind that if this graph were able to scroll back and forth, that would look like a ridiculously insane rise, and so would that, and so would all of these. That's just the nature of when there's a bigger, higher spike, the previous one looks smaller, you know. But yeah, I definitely think S&P 500 index fund is a great option with around 10% returns per year. Recently it's been going even better than that, provided you can make contributions to it quite reliably, and provided you have a plan, you know your time frame, and you don't need the money anytime soon. And that's pretty much all I've got on index funds. So thanks for watching. Have a great day. Leave a like, comment, and subscribe. See ya.